Uh, I'll share my screen. Please switch off your volumes. We start today's market talk. There are old investors and there are bold investors, but there aren't many old bold investors. So the only way out is to remain cautious and hope to attain the longevity that most investors seek by remaining in the market and not get taking too much of losses. Exercise caution in using leverage. Lot of brokers are offering uh, that margin money to buy more stocks and all that. Avoid that at present when their markets are volatile, or take debt for buying stocks or creating positions. Okay. The market outlook. Markets do not like uncertainty, and there is always an element of that during elections. And this time, the VIX is much lower actually that we have seen in the last three general elections, but it has moved up from 10 to 10 on around 23rd April, which led to complacency to around 18.4 on 10th May, and it is every day going up. Major trend in the market now is aggressive selling by FIs, though DIs are buying, and they are not as aggressive as they were due to some concerns surrounding election results. There are other issues also. First is actually there are three issues. One is there is a valuation contrast between Chinese and Hong Kong markets, which are at a PE of around 10, and Indian markets are nearly double the PE of those. Hence, the money is shifting. FI money is going there. The other reason is that there is a postponement of rate cuts in the US until the year end. So one of the reasons for the rally here is obviated, and so the US bond yields have risen. And also, every election phase, the uncertainty is creeping in and is reflected in the capital market. US stock rallied on earning optimism and data that's.
You speaker பேசுறது சரியாவே காதுல விழல எனக்கு.
Please switch off your volumes. US stocks rallied on earning optimism and data that supported the case for interest rate cuts. There is a slowdown in US jobs report that sent the bond yields lower, with bets on Fed rate cuts getting revived this year. Swap traders are pricing April employment at least two rate cuts after the April employment report vindicated the Powell's decision not to become hawkish at their May meeting. So there is a probability that there may be at least 1/2 rate cuts this year. Next push for equities may well happen after the election result, followed by union budget and probability of lower interest rates. Expectations are of 2 rate cuts by RBI this year, one in Q2 and one maybe in Q3. And if global trade picks up, then all three engines of economy, investment, consumption, and exports will pick up. RBI tightened the lending norms for project financing. RBI proposed to increase provisions to 5% for loan amount disbursed for project in the construction phase. Until now, the requirement was 0.4%. What it will impact is that it will result in increase in interest rates for projects finance loans by around 150 basis points. So what banks are saying is do graded provisioning requirement for projects. That means it should be different for government project because there is least risk and triple A rated projects, and different for others. And the other point is that the private capex, which is just about getting revived, will be impacted in a big way. Now, few results which are important. First is L&T. It maintained its double-digit growth momentum in Q4 FY24, led by core projects and manufacturing business. It is sitting on a strong order book, but due to run-up in stock prices, there is a limited upside. Infra segment of L&T posted 22% growth, strong growth in high-tech manufacturing businesses. Financial services business was strong, while IT services business was muted. Remember, L&T is now a conglomerate, and it's a holding company of all the IT companies and financial part and the real estate part of L&T group. EBITDA margins at 10.8 was lower than 11.7% year on year. elections and Israel-Iran conflict can impact order wins and project execution for L&T. Their CEO has said that this is actually a 8-month year for L&T in terms of getting orders. Order book is around 4.75 lakh crore. So growth visibility is there on medium to long term, which is okay. FY26 EPS is around 158. So at 2022 PE, it is fully priced, and some of the parts valuation comes to around 3,500 based on FY26 earnings. So every dip around 3,000 level should be a good opportunity to accumulate this stock, but don't expect this to run up too fast. The other good result was Cholamandalam investment, promising outlook and all-time best disbursement growth, profitability, and asset quality. PAT jumped 25% year-on-year, crossed 1,000 crore mark. AUM is around 37% year-on-year. NIMS at 7.5%, ROA at 3.4%. Stock is at 3.6 times FY26 price to book. So it is now becoming expensive. It was cheap at around 1,100 when I had recommended to get this. All segments, vehicle finance, home loan, loan against property, SME, consumer and small enterprise loan, secured business and personal loan, etc., are seeing good growth. Just for a comparison, the Bajaj Finance is at 4 times price to book, and book value for Chola is around 350. So it is now around 3.6 times. Any upside will make it expensive. Hero Motocorps is seeing a surge in demand, particularly in rural areas, supported by the combination of renewed consumer interest and new models in the premium segment. It is likely to see better demand in rural areas, and the margins improved for this company as raw material costs decreased. So we saw a big improvement in operating margins. Multiple launches across segments help in gaining market share. EBITDA margins improved by around 225 basis points year-on-year. They plan to introduce EV products in near future, establish dedicated EV dealerships. They are launching Charisma XMR MC and Harley Davidson X440 nationwide. Now at FY26, expected EPS is 275. So this is relatively cheaper as compared to the other motorcycle companies. It is at around 18 PE, so there is still some value here. Coming to technical issues, so as expected, the US 10-year yield, which was dipping, has now and then had started. It was dipping, then it started going up, and now it is again coming up. So level to see is around this 4.3 level. If it breaks this 20 EMA, based on the recent jobs data, now it is dipping. So which is good for equities. Dollar index, again, it had gone to 106 plus, but now it is coming down. So again, same issue. So we'll have to see whether it can break below this declining trend line. Brent crude prices, after the issues in Middle East and geopolitical issues, it is also correcting. So it has come down to that declining trend line support. So if it breaks it, that will be good. Gold, it was correcting, and then now again there is a hope for interest rate cuts. So again the gold spiked. So now I think it will always trade generally now at these levels. A big correction is looking unlikely. Now Nasdaq, this is a weekly chart. So if you see here, it is at 3 good weeks and it had a positive week. This is basically 2 reasons. One, good earnings. And the second is the possibility now of rate cuts, or at least there will be no hike in rates now as such. Now India VIX, if you see here, it around 23rd of April, it made a low of around 10. And after that, it's on a rising path, and every day it goes up. So it has around 18.5. Now the impact of this is on everyone. So even if the stock market goes up, and if you're an option seller, like a put seller, the premiums don't go down. Premiums still keep going up. So that is the problem because of rising VIX. So one has to be careful with this. but around election time, it goes to 20 plus, around 2025 level. The problem with this is there is intraday volatility, and then there are gap ups and gap downs. So which take out people's stop losses if they are trading for positional trades or something like that. Now, Nifty 50 weekly chart. So if you see, it had a red week. Previous week it had made an all-time high around 22,800, and then it has corrected. It has come down to test the 20 EMA on the weekly charts. So if it breaks down from here, then it will be very negative, and then it can go down much further down. Now let's see the daily chart. Nifty 50 is a daily chart. So if you see here, after it had made a high in 5 trading sessions, it went through the 20 EMA, 50 EMA, and now may go and test the previous low it had made of 21,800. It may test that definitely, because this is the level it may test, and then we'll have to see, and that corresponds to 100 EMA. So this is inevitable. It can happen any day, because sentiment is right now slightly soft. Now, if you see the hourly chart, firstly, the hourly chart, it is below all moving averages, so it is weak. So it has to break above the 50 EMA to get some strength, so that the level is 22,287. Above that, only the strength will come. Now, if you see here, what is happening is it has a fall, then next day it consolidates, then again it has a fall, and then it consolidates the next day. So one has to be careful. It is not showing any upward trend. It is only drifting downward. So one has to be careful, and it will, I think, definitely test the lower levels maybe in next week or after that. And then other thing is, after every phase of the election, there is a dip. Now this is Nifty Bank. So if you see here, this week again, it has the same level, similar level as Nifty, coming and testing the 20 EMA on the weekly charts. So we'll have to see here. Now on the daily chart, so if you see here, Nifty Bank has been on a downtrend after it had made a high of around 49, nearly had gone to 50,000 levels, and then it has gone down. So last week, if you see here, 5 candles, it has broken through the 20 and 50, and then it will definitely test this 47,000 level, which is the 100 EMA, or the low it had made to around 46,800. So that becomes a possibility. And if you see the last candle, people will see this on Friday as a inverted hammer, which is negative, and which you can see a lot of call writing and short positions being built in Nifty Bank. Now HDFC Bank has broken through all the moving averages and has broken below the 200 EMA also on the weekly chart. So it is looking weak, and it is dragging both the Nifty Bank and the Nifty down. And I'm sure we'll have to see if it goes down below 1400. It may test the low it had made of around 1360 odd levels. But this is looking weak. The stock which is looking strong is which has come up with good results is ABB. It has made a fresh all-time high of around 7,100, around 7,200 levels, and it has rallied very well from these 4,000 odd levels where we got this stock now to 7,000 levels. So it will continue to do well based on good results and good order wins. Midcap index is correcting. It had made an all-time high, but it is now correcting. Let's see if it can take support at 20 EMA, because over the last year or so, it has always taken support at 20 EMA. Small cap index, similarly, it has had a big red candle, bounced back from the 20 EMA. So we'll have to again watch. But these two indices are causing problems to the portfolios. Zomato is one of the brightest spot here. It has constantly, if you see, traded above the 20 EMA, and it's a strong stock, and it's broken through 200 levels. And so one has to get the trend correctly, and around 100 odd levels we had got this trend right. And if you have remained invested, your money would have been doubled. Hold on to this after result should see an at least 230 to 40. Now I'll cover three stocks today. First is SKF India. uh, this is a company which basically makes bearings. So this is it's got a MNC parent. So it's a very well run company. And if you go to the market and you ask for bearings, the best bearings are of SKF. Now they reported best quarterly results on year basis in the past few sequential quarters. The company has clocked highest year-on-year revenue growth at 10% and second highest gross margin at 41.2% and the highest EBITDA margins at 17.7% in the 5 sequential quarters. They will clock double-digit year-on-year revenue growth in FY25 and 26, led by domestic demand, focused on Southeast Asian market and a decision of SKF AB, their German parent, to relocate production of few products to India. They are relocating from South Korea because of the cost factor. Estimated revenue, EBITDA, PAT CAGR is 11.6, 13.4, and 11.8 over FY24, FY26. Only problem with SKF, I'll show you, is there is a volatility in gross margins and tax rate on quarterly basis, which is impacting their profits. But if you see here, FY24 fourth quarter revenues were, as compared to FY23, the revenues were up nearly 10%, EBITDA up 27%, EBITDA margins were better, and net profit and EPS up around 42%, and that is leading to the spike in the stock. Even on Q-on-Q, it was good. And if you see here, expectedly the EPS is going to grow around 10, at least double digits, low double digits. So it is expected to do around 139, 140 rupees in FY26. So you can easily price it at a PE of 40 because there is a consistency in growth. So at 140 into 40 comes to around 5,600. So that should be a decent level. Because if you see here, it has around traded at around 40 P throughout. So right now, at present, it's around 32, 33 times FY26 earnings. Now, if you see here, their balance sheet, they have no debt. So good cash position and good cash flows. This is their balance sheet. So if you see here, and ratios, if you see, are generally good. Margins are very good, and ROE, ROC are above 20%. And debt is not there, and EPS I had told you about. So it's a good stock to hold for long term, and it gives dividend also. Now let's see the pair comparison, and this is what I wanted to highlight. Now if you see here, market cap wise, now expected sales growth over the next is the same for SKF, Timken, and Schaeffler. Even EBITDA growth and EPS growth is generally the same. This one is slightly better, but this is trading at a lower PE as compared to Timken and Schaeffler. ROE is also much better. It's in 20% plus. Others are at 16, 15, that kind of thing. And ROC is also higher. But it trades at a lower PE because of variability in margins and profits and tax issues. So this is the only problem. Their sales to heavy industries, automation was significantly higher, improved to material handling and railways, unchanged to industrial distribution, aerospace. Sales to high-speed machinery, electrical drives, renewables, agriculture, food and leverage, etc. off highways and marine was lower, and higher sales to light vehicles. Now, if you see the chart here, SKF, it had made a high of around 5,600, but it has dipped from there. So this was the declining trend line. Now it has broken out above from here, based on expectation of good result. And on last week was very good. It nearly went to 5,000 plus. Then it consolidated a bit, but it is now poised at around 5,000. So it has some way to go up. It can at least test the previous high based on this quarter results and good management commentary. The other stock is Jupiter Wagons. Revenue, EBITDA, PAT saw a strong growth of 57%, 60%, and 167% year on year, led by higher volume growth and better margins. The company manufactured highest ever 2520 wagons during the quarter, a whooping 64.5% year on year and 31% Q on Q growth, which corresponds to a run rate of 840 wagons per month. Order book remained healthy at 7,100 crores at the end of FY24 versus 7,080 crore at the end of Q3. This was helped by 960 crore order from Indian Railways for 2237 BOSM wagons. This BOSM is Boxen high-sided open wagon with side mechanism, and 470 crore order from Defence for 697 BOM wagons. BOM is bogie open military, and rupees 100 crore for an auto OEM. With a brownfield expansion at Kolkata Foundry, capacity has increased from 2,500 million tons to 3,000 million tons. The company's wagon capacity has increased to 900 wagons per month. Further, it expects the greenfield foundry at Jabalpur with 2,000 million tons to be completed by FY25, which would bring the total capacity to 1,000 wagons per month. So this is what they are working on, 1,000 wagons per month. That is around 3,000 wagons per quarter. Recent acquisition of Bonatrans India at 270 crore, so 1 crore, makes it a completely integrated player capable of manufacturing wheel sets. They supply brakes, battery systems, and wheel sets to Vande Bharat, which is nearly 30 to 40% of the total value of the coach. Expect final certification to be received within 7 to 10 days for ELCVs, this thing lightweight commercial vehicles, and expect a launch by July 2024. They are raising capacity to 1 lakh wheel sets per annum for 10,000 wheel sets over the next 2 to 3 years. Now let's see their this quarter results. Year on year, the revenues were up 56% and Q on Q 25%. EBITDA similarly 59%. PBT approximately 79%, and PAT was up 387%. So from 392.2, it made 392.2 crore. From, if you see year on year, for this was Q4 FY23, 392 crore, and from here it has become 1,046 crore. So it's a big increase, and even Q on Q it is up 28%, and EPS has also grown similarly. Is expected to be around 2.5 for this quarter. Now, if you see here, now let me tell you what is the problem for this company. Jupiter Wagons revenue is expected to go up to around 6,370 crores over FY26, but because of high debt, the interest cost is also going up. So roughly around 47 odd crores it is paying as interest, and it is going up because it has taken a lot of debt. So it is expected to around 16 rupees EPS. So you can easily value it at 35 times, seeing the growth part and the demand for more wagons. So at 35 times it comes to around 540. So it has still some way to go. Now the problem for them is the ratios, revenue growth, etc. are good for this year and expected to be 30-35% over the next years, and margins are expected to be sustained. The problem is working capital cycle. Working capital days have increased. So there are a lot of money is required to run, and I'll tell you why it is also required. Though ROE, ROC is also good, the debt is becoming higher as compared to equity. The point here is that they had done a QIP, which I'll show you. So the PE is expected to go down. So at least 35 PE is okay for this. Now the problem comes here. see the cash flows. Now, you see, this is in millions. So their working capital has gone up by 410 crores. And capital expenditure was also 420 crores. They were able to have positive cash flow only because they did a QIP of around 500 crores this year. Hence, it's a problem for them. And because of this QIP, there was a equity dilution. So the equity share capital has gone up. And how it is reflected is in their short and long-term debt is going up to around 467 crores. And they have a lot of receivables. Sundry debtors are 490 crores and it is going up. The problem is they have a lot of receivables, so money is not coming. Hence, they require a lot of working capital, so that part of the business they have to improve. Otherwise, the business is good, but it can create a problem for them because they require a lot of money after that, and then the interest rate cost goes up. Now, outstanding order book is good, 71,000 crore. 7,100 crores as on Q4. Quarterly financial performance is good. So EBITDA is going up, PAT is moving up, and margins are at around 13%. Railway productions quarter on quarter is improved. CMS Crossing quarterly production jumped 55.9%. CV bodies and components production was down, and container quarterly production was up around 5.3%. So if you see their chart, it was moving gradually. After these results, it has gone up. It has some more way to go up, but it is now becoming slightly overbought. So there would be some dip, and then it will. And if they continue the performance, it will go beyond 500 odd rupees. Now the last stock today is Newland Labs. It's interesting stock. Now, pharma R&D outsourcing total addressable market is around USD $200 billion. Newland is a leading manufacturer of active pharmaceutical ingredients, APIs, and an end-to-end solution provider for pharmaceutical industries' chemistry needs. Over the years, management has transitioned the business from pure play APIs to also providing CDMO, which is contract development and manufacturing organization services to innovators. Catalyst for the company in the form of improving biotech funding environment, new capacity at Unit 3 coming online from FY25 end, and commercialization of large molecule in FY26-27. Challenges to FY25 growth on account of high base. The CRO industry, CRO is Contract Research Organization, is expected to grow at 10% CAGR, while the CDMO industry growth is expected to accelerate to 14% CAGR over the next 5 years, implying 13% growth for the overall CRAMS and CRDMO industry over the same period. Now, if you see here, the global CRDMO and CRAMS market is expected to grow at 13% over the next 5 years as compared to 11%. So there's a lot of scope. And India and China offer meaningful cost advantages in CRO, contract research organization, as well as CDMO segments, because our costs are relatively lesser as compared to US and Europe. So that advantage is there. But our market share is around 2.7% in CRO, and in CDMO it is around 1.6%. So it can grow up also. Basically, they have to develop capabilities, these companies. India's advantage is cost, lower gestation period, and shorter contracts. Now, if you see here, coming to specific companies which are dealing with this, Newland and Syngene have seen the most market share gains over the last 5 years. So the highest market share gain has been with Newland, then Syngene, Suven, Divi's, Laurus, and Piramal. While Syngene has the highest exposure to innovators, and Syngene offers the widest range of services, followed by Piramal. So Syngene is in all aspects of this drug development and research and all that, as compared to others, and Piramal. Now, if you see Newland here, Newland was a very normal stock performing API, and then suddenly in March 23, there was a major rise in revenue, and that was reflected in the stock performance. And it says the profit went up and EPS nearly became 3x. And after that, it has remaining at that level. Then there was a spike again in September. And now after that, there has been a dip. And this quarter, it has come down by around 15-20%, the profit. Now, if you see the expectations, if you see here, the revenues are expected to remain at the similar level in FY25 because of high base of 24, and then improve in FY26. So that's why the stock will see a dip, and you will see from here EPS also roughly around 240 rupees EPS for FY24. It's expected to go down in 25 and then go up in 26. And you will see this performance in the stock's performance also. The sales growth are not going to be there in FY25, and EBITDA, EBIT, net income, EPS, etc. are expected to go down. Gross margins are expected to be sustained, EBITDA margin, etc., and EBIT margin. So what is happening is, if you see here, the March results were good. Result must have come in April, and then there was a spike in the stock. Then the stock was going up. Then the October quarter, the results were good. Results must have come in November. Again, there was a spike. And now this stock is coming down or correcting after the results. In my opinion, roughly around 20-25 P at 200, which is FY25 expected earnings. If it comes to around these 5,000 levels, that should be a good level to get in, because they are expected to do well in FY26, not in FY25. So that should be a good level to get this stock, and not at these levels, because next year is expected not to be good. I have finished. We'll take questions now.